Before you sign a hard money loan, there's one term buried in the paperwork that most people skip right over. It's called recourse. Whether your loan is recourse or non recourse decides what happens to you personally if the deal goes bad. And most borrowers don't even think about it until it's too late. Today, I'm breaking down what each one means, how they affect you, and which one you should look for in your next deal. I'm Aidan. I funded hundreds of millions of dollars in hard money loans for real estate investors across the country. This is one of the most common questions I get. It's also one of the most misunderstood. A lot of investors think non recourse means zero risk or that full recourse is always unsafe. Both are not fully true, so hopefully this video we can clear that up. Here's what we're going to cover. First, what is the real difference between recourse and non-recourse and what each one means for you. Second, why lenders pick one over the other. And third, which one makes most sense for you for the type of deal you're doing. Let's get into it. What does recourse mean? Recourse means that the lender can come after your personal assets if the deal fails. If the property sells for less than what you owe it for, the lender can pursue the difference. This means that bank accounts, other properties, personal assets are all fair game because you personally guarantee the loan. This is how most hard money loans are set up, as this full recourse. This is standard in the industry and it's not really a red flag. It's the most common approach. On the other hand, non-recourse means that the lender's recovery is limited to the property itself. If the deal fails, they can take the property, but they can't come after you personally. Your personal assets are protected. This sounds great on paper, but there are always important catches. Non-recourse loans almost always have what's called bad boy carve-outs. So looking at the fine print, what are these bad boy carve-outs? It means that even on non-recourse loans, certain behaviors make the loan recourse again. Common carve-outs include fraud, misrepresentation, environmental contamination, also failing to maintain insurance, unauthorized transfers, bankruptcy filings. If you trigger a carve-out, then the non-recourse protection disappears. This is why reading into the guarantee agreement, the document where you personally signed onto the loan, matters, not just the loan docs. Non-recourse does not mean no accountability. So now that we can discern between the two, why are most hard money loans set up as recourse? The reason is that hard money loans are short-term and higher risk for us as the lender. Recourse gives the lender an additional layer of protection. It forces the borrower to have more skin in the game and incentive to complete the project. Lenders can offer better terms, higher leverage, lower rates because recourse reduces the risk. If you want a non-recourse loan, expect a little bit of work finding a lender who will accommodate it and also expect to pay a little bit more for that. So when does this recourse make sense? When we look at fix and flips, when you're in and out in 6 to 12 months, generally the risk is light. When you're confident in the deal and your ability to execute, when you want the best terms possible, highest leverage, lowest rate, when you're an active investor who controls the outcome, or when the property is the right deal at the right price, the risk becomes manageable. And real talk, my opinion is that an investor should always be comfortable with recourse. It means you truly stand behind the deal you're presenting. And although we do offer non-recourse options, sometimes it can come as a red flag if a borrower is not willing to sign a personal guarantee. On the flip side, there are some situations where it might make sense for the investor to look for a non-recourse loan. That is when, the deals are so large that the exposure is very significant on your end, or when you have substantial personal assets that you're truly trying to protect, when you're syndicating, raising money from multiple investors to fund a deal, and partnering and need to limit the personal liability, or when you're just willing to accept slightly worse terms in exchange for the protection of a non-recourse loan. Here are some mistakes, though, that I see investors make. They assume that non-recourse means zero risk. As we spoke about, it doesn't. Not reading the carve-outs if they do choose a non-recourse loan, which can effectively make it recourse. Choosing non-recourse purely out of fear and getting worse terms on a deal that didn't really need it. Or not always asking the questions. Some investors don't find out until closing day. And the last thing is always ask up front, is this recourse or non-recourse? And if it is non-recourse, what are the carve-outs that are implied? So here's how to think about it. Recourse is not a bad thing. It's standard and expected on short-term deals. Non-recourse is a tool for specific situations, not a universal goal. The best protection is buying the right deal at the right price. A well-structured deal with strong margins protects you way more than any loan clause. And then lastly, use the loan structure that fits the deal, not the one that sounds the safest on paper. And if you've got a deal you're evaluating right now and want to see whether the numbers actually work before you get into the paperwork, we built a free hard money approval calculator. Plug in your deal numbers and it'll show you exactly what a lender would offer so you can figure out if the deal makes sense before you start worrying about whether it's recourse or non-recourse. Click the link below to try it out. Now you understand the real difference between recourse and non-recourse, what the carve-outs actually mean, and how to think about the structure that fits your deals. This is the kind of detail that separates investors who build wealth from the ones who get surprised by the fine print. Subscribe because I'm putting out new content every week on the things that actually matter when you're funding real estate deals.